I think we're live. All right, good afternoon. It is Tuesday, December 13th. I'm Samantha LaDuc, founder of LaDucTrading.com from a chilly little Boston. And I am joined by Craig Shapiro out of, I'm sure, warm Naples. I am very happy that we could kind of talk macro to micro this afternoon. Craig heads up, he's my longtime client and hedge fund manager turned macro advisor, Edge resource for all of our LaDuc trading clients, and very much with CPI having printed this morning with a surprise beat, so to speak, and FOMC front and center tomorrow, the least of which is not over, by the way, for dramatic events. We also have the largest notional value in options expiration on quad witching this coming Friday. So we've got lots to discuss, and there is basically a lot of event risk this week. Markets have been acting very volatile into the prints, after the prints, and then fading the prints. So we have a lot at stake leading up into tomorrow. I thought one thing that might be helpful is to kind of start off with a little bit of a micro before we go to macro, because of a chart that I gave to clients where we have been really in this, let me just get it real quick, in this big picture chop. So share a little bit of what I shared with clients, which is, here's SPX, right? And this was obviously sent earlier, but the point is, we have been moving off of this October 13th low, and then over here you'll see this big expansion bar on October 21st, which was Bank of Japan yen intervention. We had some obviously quite volatile chop in between, but this was the last CPI from November. So this was a massive bear trap. And then we had a historic rally from the lows to the highs, about 5 standard deviation move. So it was extremely outsized. And then we went into this kind of consolidation pattern. You know, this trend line, the famous trend line from the highs, we definitely tagged it and then petered out, but we did not break. We really just kind of churned sideways into the next kind of trend line before this morning's CPI. So we did hit, quote unquote, a double top of this 4,100 area. I was on an IBKR podcast back on November 1st with Steve Sosnick, where I talked about pre-CPI and the last FOMC meeting, that if they did not do a Fed-induced rug pull, we could see 4130. You can kind of see this level right here. We haven't tagged it. Yes, in futures we did, but I don't really consider that. It's the regular cash session that I was really focused on. And we could always overshoot and get a bullish bent right into this gap fill, obviously, another 100 points higher. So we definitely have potential to move into this print post FOMC, or even on Powell's presentation at the podium tomorrow. However, we did a very strong reversal off the high. So as soon as we opened, we faded. Granted, this is a few hours old, but the point is we've got this support around 40.50, and that really needs to hold. Otherwise, we're going to come right back down and do a nice big gap fill. So we have a really big wedge here of churn and chop. So just from a micro standpoint, if we were to take out some of these levels, 39.31, we go down to 3,900, obviously, we're going to break down and we're going to see, this is 3,900, see another gap fill potential all the way down to 3,800. So we basically are right in the middle, right between these two gaps. So I just want to kind of put that in perspective as far as the micro, and now we're going to kind of talk macro. Talk to me. What do you think about the CPI print? I'm going to try and unshare.
Well, before you leave that chart, I think it's interesting just thinking about this this wedge or whatever, this triangle that kind of seems like it's ready to kind of make a big move in one way or the other, kind of over the course of the next, few weeks or so. And kind of not surprising that we're like into a Fed meeting tomorrow where we're talking about seeing, possibly the end of the rate hike cycle. We're also seeing, some slowdown in the economy that is being picked up. So it almost feels kind of poetic that we're kind of getting to this point, and I'm not sure if it's going to be, a breakout or a breakdown kind of before the end of the year, but I suspect, certainly when we get into January, a large move will be made in one direction or the other. And I think the driver of that move will be, the Fed's reaction function to the data that it's observing right now. And so I think there certainly is a case to be made for a step down in rate hikes from 75 to 50 in this meeting, and possibly 25 at the next meeting or after that, right? I mean, they're guiding markets to look at core CPI and core PCE, and it's very likely that after this being the second month in a row of deceleration on core CPI, that next month's reading, meaning the December reading, will show that third month in a row, which the Fed likes to talk about a series of better inflation data. A series in their mind is 3. So a couple is 2, a series is 3. So we would be at 3, and there would be more justification for them to step down again at the Jan Fed meeting, and possibly finish at that point in time. But it's also possible that they will look at the strength in the labor market, which I've been talking a lot about, and we continue to observe, where wages are still incredibly robust, and wages are a forward indicator for that core services inflation reading. And so unless we see more destruction on the labor front, a more protracted downturn in job creation, a pickup in the unemployment rate that leads to an even more protracted slowdown, unless we get that, we're not going to solve the inflation issue. But clearly the Fed has become very divided, hawks and doves at this point, with Powell leading the hawkish camp and Brainerd leading the dovish camp. And Brainerd is concerned that perhaps we've done too much, and that these recent inflation readings are suggestive of the fact that things were a bit more transitory finally, and inflation readings are going to come down aggressively over the course of the first half of the year, and there's really no reason to be doing a lot more. And Powell and others like Waller or Bullard or Nestor are more in the camp of an incredibly tight labor market that is still seeing a robust wage outlook. So, I mean, we're it's kind of one of those, I don't know if it's rare, but it really feel like into tomorrow, it's hard to say how they're gonna decide. Clearly the market was reacting today to the weaker CPI print with some aggressive buying, and throughout the day, and that there was call monetization, put monetization, and so the reaction wasn't as aggressive as where we saw at 8:31. But I still think we are in TBD mode tomorrow. What I think is going to happen is I think Powell is going to try to tell the market that he remains resolute in his attack on inflation. He likes what he is seeing, but the job is not done, and there will be more tightening. And really, what I suspect they want to start to push back against is this idea that imminently after the terminal rate, which at this point is in May, that they're going to immediately start cutting rates. Because right now, the market has priced in aggressive rate cuts for the second half of 2023 and for all of 2024. And it seems as though the Fed, by saying they're looking to, get the terminal and pause for an extended period of time, there's a gap there between what does that mean for the Fed and what is the market pricing in. So I think we're going to hear a bit more tomorrow about, trying to square that circle.
All right. So one of the reasons why I had this chart up while you were talking was to kind of comment, because we were talking about this move today. CPI obviously was lower than expected, hence the bullish rally, but it was kind of interesting how we bounced at the dollar mark of $103.65 exactly, which caused the profit taking right at the open. Obviously, it came down, then it picked up a little bit more speed. It looked like it was going to go a full, green to red. And in some cases, it definitely did. But this is a chart that I posted for clients back on the 2nd of December, which was basically the price target. We can still overshoot that and head lower, but I still think that this is a better read, for me anyway, than trying to game the FOMC. In other words, the dollar makes the weather. And right now, this has been falling perfectly, kind of tactically, technically, however you want to put it. And it came into that 103.65 this morning, right? The dollar dumped very strongly as stocks and bonds rallied very strongly on that weaker than expected CPI read. And then boom, we had this nice pullback for the bears. And it was really tough for bulls going, hey, wait a minute. But strategically, this rally could absolutely still move higher. Of course, whatever Fed forecasts tomorrow, I should say Powell with the future in pause or pivot. But for the most part, I'm just saying another way of staying with this rally for those who are bullish, despite the shake and bake that we've had. Not just for days, but weeks, but months. We really have just been rotating sideways in volatile swaths. But the point is, we could still fall in the dollar down to like 102 area. Mm-hmm. That's where I think it gets really, really strongly defended. I just kind of want to kind of point that out, because this is very tough to game CPI. It's very tough to game the Fed. We could be done going down in the dollar right now. I think we could have another rug pull down to 102. And why does that matter? Because it's extremely bullish for yen, for gold, for bonds, and with that for stocks. So if we, that's really where I had recommended for clients to kind of tighten up in regards to the dollar move, kind of corresponding with the CPI and with FOMC, very much so. So I showed that kind of chart of SPX, but we have talked about wages a lot and inflation expectations a lot. One thing I wanted to point out was yesterday we were in the room, and remember, inflation expectations by the New York Fed were going to be coming out for the 1, 3, and 5 year inflation expectations. And one thing that I said was expect the 1 year to be very soft because it tracks oil. And oil, as we know, has fallen in the past since mid-November really strongly. And this, by the way, is just an overlay that also Steve Sosnick from IBKR had posted the other day. And it shows beautifully, the correlation between 1 year inflation expectations at the New York Fed and the price of oil, also RB gasoline futures. So to me, this was the reason that we got supported yesterday. This came out at 11 o'clock and the market rallied. And I said, I want to keep the trading room open because I think this is going to be soft for the 1 year because oil has been so depressed, right? Or I should say suppressed. And we had that very strong move in, into the rest of the day. Net buying as well as, price action. And then CPI, it's very hard to game CPI. Is it going to be weak? Is going to be, strong to that, relatively speaking, 7.3 area. It came in weak and the market got all bulled up. But that entire gap is unwinding because I also believe that the expected move for this week matters. So we had a 2.7% expected move for SPY. And between Monday morning and this Tuesday morning open, that was 4.1%. So we've already had a very large move in the market, and dealers were basically kind of pressed to, I think, sell into that gap up this morning. So now that we have kind of CPI out of the way, and we absolutely have wage inflation sticky. We have, input costs are still strong. Big discussion, right, that we've had regarding like wages and outperforming productivity. Will the Fed see this as something that they have not conquered, Or do you think they will play Santa, not Grinch? Like,
Right.
ultimately, it's very hard to know, but, you know, baseline bet,
Yeah.
what do you think is going to happen tomorrow with FOMC and with Powell?
So I think what's different about the setup into this meeting versus maybe the last couple meetings or the last few data points that typically like a CPI or a payroll print that will move rate expectations. What's different now that I see is that I guess over the last few months, after, let's say, Powell's hawkish Jackson Hole speech, that into these events, the market has aggressively, the bond market specifically, has aggressively priced in the tightening cycle. The terminal rate, I think the peak in the terminal rate, I forget exactly when it was, but it was close to 5.15%, right? So we were pricing in, maybe it was after the hot September reading, or maybe it was during the September meeting, where the market kind of really got very aggressive as far as, and I know Nomura had said that, they expect 5.75 to 6% Fed funds rate terminal, and Street was taking up expectations. And what has kind of happened since then is because of the data, the CPI data coming in weaker than expected, we've seen the market kind of price that out and take that out. And that has been kind of corroborated by the Fed step down from 75 to 50. What we have into tomorrow is we have the terminal rate now for next year at basically 4.85%. So the terminal rate as of the last meeting was at, or as the last dot plot was looking at 4.62%. Powell has said they expect it to move up slightly at the next meeting, the next summary of economic projections, which would intonate 4.85%. So basically the Fed funds is actually at where the Fed has said they're likely to be at. So we're not really pricing in too hawkish of a Fed at this point. And if you look at the forward curve in Fed funds rate, basically now the market is expecting close to 150 basis points of rate cuts between the middle of next year and the end of 2024. So the market is now looking for a substantial rate cut cycle that immediately begins. Now, Waller and Bullard and others have said they expect rates to remain in restrictive territory with no cuts for the entirety of 2023. So it's almost like the bond market has gone from too hawkish of expectations about what the Fed is going to do to way too dovish as far as their expectations of what the Fed is going to do, kind of beyond terminal. And so what I think is tomorrow there will be pushback against this idea that the Fed is going to imminently start cutting rates in the middle of 2023, and that rate cut cycle is going to be an aggressive rate cut cycle. And the reason is because, as you said, because the labor market data is still too robust to really give anybody or at the Fed confidence that now is a good time to start thinking about pricing in those cuts. So what I suspect is going to happen is they take up the terminal rate for 2023, and the dots in 2024, which now are very erratic and widely dispersed, will show a higher number than the 3.8% expected, which is in the current SEP. So I think that number moves up as well, which is their attempt to push back against this idea that the Fed's going to be cutting so aggressively, in 2024. So I think that message can come across as hawkish. And that message is basically one of the economy is slowing, but the labor market is still robust. And so the Fed is unable to provide incremental liquidity into an economy that is showing early signs of slowing, and that it will need to see a much more protracted decline in growth momentum before it could provide liquidity. And something I've been saying for months, and certainly prior on these webinars, is that for me, that timeline to Fed adding liquidity is what drives risk on or risk off behavior. And so as we learn that the Fed is still far away from providing that liquidity, it's negative for markets when we see growth data decelerate. And so, the ISMs are pretty poor. We'll get retail sales later this week. I see some of the consumer names have been acting pretty poor. I know the airlines today were pretty poor on a demand destruction comment from JetBlue. So, some of the Costco numbers were a little bit weak right there. There is weakness at the consumer level, which I expect is going to continue to accelerate as we move, over the course of the next few months. And, a slowing economy that the Fed cannot do anything about, I think, is one that shows, deteriorating earnings momentum and lower stock prices. And if it's, kind of goes hand in hand with a fall in inflation, well, don't forget, inflation going down is going to be a headwind for earnings growth, right? I mean, part of the earnings growth story this year has been nominal prices have been able to go up, sales have been up, and that's helped. That starts to turn, next year, that is a headwind for earnings growth momentum. So again, in sum, I think the Fed tomorrow kind of pushes back against this rate cut cycle because the labor market remains robust, but it is that concept that is risk off, because the market, to my view, the market kind of begs for Fed liquidity around, at all times, and when it's told it's not getting it, it revolts.
And I'm showing this Fed liquidity chart that you keep posted for clients. This is just a nice kind of fractal with SPY on the same time frame. So it has been very supportive of.
Yeah, look, and what we've had for the fourth quarter is we've had a massive drawdown in the Treasury General account. And it doesn't look like the Treasury is actually going to rebuild its cash hoard as aggressively as we and everybody, and even that they had said a few weeks ago. They had talked about getting cash levels back to $700 billion by the end of the year. They're currently $355 billion. They're not going to get there. Part of this has been kind of a political game that they played to try to get the debt ceiling negotiations done sooner rather than later. But that doesn't look like it's gonna happen. But they're seasonally, over the last 2 weeks of the year, after the tax payment gets made for December 15th, there is typically a build in the Treasury General account through year end. And the other big driver of that is the reverse repo facility, which has seen a big drawdown. Money has come into the markets, but over the last 10 days or so, we've seen 150 billion go back into the reverse repo account. And then the last thing is QT, which is up to 95 billion so far this month. We haven't seen any of it. We haven't seen any QT yet, really, this month. So we should see that over the course of the next 2.5 weeks as well. So we're likely to get liquidity contraction over the course of the next 2 weeks, which could add to a more of a risk-off flavor and maybe put some coal in the stocking of the of a Santa Claus.
Yeah, we need to get
Santa Claus rally
down and stay below 40.50 and SPY. But I have up here your real 2-year, and this chart says what? I mean, recently an entire rate hike just disappeared, right, from the forward interest rate curve on this equity exuberance here that we've had.
Yeah, but you can see like the white line there is still real yields. I mean, they're still, and that's inverted. So real 2-year yields are still very close to the highs of the year, which is historically has been a fairly decent headwind for equity multiple valuations. And what we could have is a situation where, as inflation starts to subside but rates don't move down with that, real yields will continue to expand further. That's considered, that'd be more tightening. So again, it's what I'm focused on is this kind of gap between where the economy is and is going and the Fed's ability to react to it. And I think that there are inhibiting factors that prevent the Fed from moving aggressively to slow down what I see as a pace of growth momentum deceleration that's possibly, accelerating and getting worse. And we can talk about, where that's coming from and China and how that fits in. But it seems like, some of the growth momentum is getting worse. So, but the Fed's not going to be in a position to really address that imminently.
So do you think that this, right now we have basically the Fed effectively helping CPI to weaken from efforts that it's put in place, actions it's put in place from a year ago. So in essence, these rate hikes are really helping. They have had an effect on inflation, and it's showing the rate of inflation is slowing. But wage growth is something that's just much more sticky and also lagging. And I have really this strong thesis, right, since October of 2021, that wages would outperform productivity. And now we still have wages, 5 to 6% year over year, and productivity is flatlined at 0. So it's still very systemic and sticky, for lack of a better term. So do you see this as also the Fed effects, right, have helped in this CPI weakening, but with a 1-year lag? Where do you see 1 year from now? Where do you see inflation really?
Yeah, look, I think there's clearly these long and variable lead times, and we can argue about, how long, or in certain sectors it obviously, takes longer, right? I mean, in the housing market, mortgage rates moved well ahead of the first rate hike, right? I mean, so the housing market has seen its deterioration, far sooner than kind of, industrial America's, labor momentum, right? For many companies, cost of capital really is not a deterrent for CapEx plans, right? A move from where they were borrowing at 2-3% to 5-6%, that extra 200 basis points of interest rate or 400 basis points of interest rate hikes. If you're thinking about a 30-year project, this is really not. It's probably not doing much to change your investment decision. So from that perspective, it takes a longer period of time. I think if the Fed were to hold rates up near 5% for the entirety of 2023. Then we would start to see, a further growth slowdown, unemployment rise, and some of these wage pressures. Look, I mean, these airlines are talking about, 8 and 9% wage increases for the next 4 years. Exxon just announced a 9% wage increase in the oil patch, right? There's the rail increases are high single digits. These are nowhere near 2%, right? So I think we're going to be in an environment where wages are higher, wage growth momentum is higher for longer for a large swath of the kind of middle part of the country in industrial America. But there certainly will be, parts on the coasts in high tech and crypto and finance that sees layoffs.
A note on the tech layoffs. We've had lots of folks worried and extrapolating out because of the tech layoffs, which, represent a whole bunch in regards to stock market companies. Like 25% of the tech layoffs are in publicly traded companies, but they only represent 2% of payrolls overall. Right. So relatively speaking, we still have a long way to go in unemployment.
Well, that's a great point. I mean, I think what we're seeing is there is these headlines impact kind of publicly traded companies and people's perception of publicly traded equities more so than kind of what you're seeing on the ground, maybe in quote unquote real America that's not in necessarily in that publicly traded companies, right? And I know, for instance, down here in Southwest Florida, where we just had a huge hurricane, like the labor market is probably as tight as it's literally ever been. So, but these companies, people and companies down here are not publicly traded. So the wage growth here is, quite aggressive. My daily contractor just told me he's raising his rates from $75 an hour to $125 an hour for 2023, right? So, that's a 60% increase in his day rate. But
and you have this chart of Atlanta CPI, which is also a very hot market that's very still sticky. Real estate as well. Same thing as Boston. Oh my God!
But the Atlanta Fed goes into the CPI data and kind of cuts out some of the volatile stuff. And, this is from today's reading, right? So their sticky CPI is making a new high. So again, it just kind of tells you it's going to take longer to, to kind of work our way through the inflation story, which I think means for the Fed is going to have to be in there for longer with restrictive policy. And that means they are further away from providing stimulus to arrest any growth disruption. And ultimately, that's not great for multiples, and it's not great for earnings. And typically, when you have headwinds for earnings and for multiples, that's usually not great for stocks.
Yeah.
So as we kind of turn into 2023, that's my, that's what I'm most, kind of worried about.
I just did up this chart for clients this weekend and posted it, which is, front and center. Obviously, we're both bullish this wage inflation and, wage demand increases. Reference, you just mentioned the airlines. A negotiated deal this weekend that kind of didn't make so much of a headline because we had so much more going on, right, with the FTX, and it was completely hidden or obscured. But the point is that they continue, like the pilots are negotiating a much bigger raise over a duration of time, and then what follows, the attendance and the mechanics, and it is a trickle-down economics type of effect with rising wages and this wage inflation that you and I have been very bullish on, but goods falling, right? This we both also agree is helping this the CPI print to soften. But one thing that we're also squarely focused on are unemployment claims right now, with the growth in the economy being what it is. We don't have a quote unquote risk off event yet. We've rolled over obviously from October, but my point is we have not really seen a fast and furious equity sell-off, and I contend we won't until we get through some of these levels in unemployment claims. And yeah, I'm technically doing analysis on an unemployment chart, unemployment claims chart, excuse me. But this is my baseline bet as well, that as the unemployment claims rise, that will come under more pressure, earnings contraction, and the rest. So they're all related, long story short.
Yeah, look, I mean, I think we've seen so far off the lows, I think we've seen close to a 350,000 rise in continuing claims off the absolute low, a low that, we basically set an all-time low in April. But if you look back, and I don't know if you have the chart, but I mean, just looking back, in 2000, when we were off the low, like we rallied 3 million. Right. And
where are you? What chart are you referring to?
I didn't send it to you, but it was here. I'll just let me see if I can send it to you. It's basically just the continuing claims chart.
Okay.
Here, let me just send it to you. Just a little bit further back. And it just shows that we have started to see some weakness in the labor market, but before we start talking about recession is when we have 3 and 4 and 5 and 6 million continuing claims. We're still in the 1.6, 1.7. So we're just not. We're just really right. Like you can see, we're in the lower right here. You can see that, in the 2000 recession where we got to. You can see the 2007-8 recession where we got to. Obviously during COVID where we got to, and where we are now. I mean, it's just early. We're just early stages.
But it typically happens slowly than all at once, which is why I kind of like my pulled out chart for those particular key levels. But I mean, big picture, we're also very much focused on the bond market has intonated a, clear recession signal. What are we going to do about that? We just moved 13 basis points in a New York minute, and the bond market still sees a recession risk dead ahead. Some are much more are making an audible. Like Hartnett just came out. Hartnett of Bank of America said he sees a recession in the next 10 to 12 weeks. And others are saying no recession for 2023. So where are you at in that spectrum? Yeah,
look, I mean, the bond market is freaked out. I mean, the bond market is scared. I mean, if I look at, let me see if I can just send this chart to you, which is basically, hold on, sorry.
That's all right.
This is euro dollar, kind of a proxy for Fed funds. Euro dollars futures in kind of the second quarter out versus the sixth quarter out. So kind of you know, 2 quarters out is when we are likely to see a peak, and then 6 quarters out, how aggressive is the cutting.
Mm-hmm.
So we're down at negative 94, 95 basis points right now. I mean, the market is expecting a rate cutting cycle as aggressive as we saw kind of at the beginning of 2008 into the financial crisis, right? The bond market is scared. So the question is, you know, why are they so scared? Am I missing something? Or is there bad Fed communication? And I think maybe it's a combination of all those things. I mean, I am concerned about the growth outlook for the economy. I think we had a stimulus fueled crack up boom type environment from the middle of 2020 through the end of 2021, where we gave a lot of people a lot of money, and now we're kind of, you know, retracting that liquidity. Both the Fed is retracting liquidity, the government's taking that liquidity away, and cumulative savings are starting to be drawn down. And everybody that bought a lot of things during COVID doesn't really need many of those things anymore, which is why we're seeing this disinflation and deflation in goods. And look, I think as far as the consumer is concerned, yes, the consumer is seeing nominal income growth that's been robust. There are growing signs that it's just not enough to keep up with services inflation. And so I think what we're getting is, you know, kind of a rolling wave of concern, right? We saw it first in housing, where there was a slowdown in housing, then there's a slowdown in autos, and now maybe there's a slowdown in travel, which, you know, the airlines are starting to pick up on possibly. There's a slowdown in retail, which the XRT is starting to pick up, and some of the, you know, larger companies have had, you know, have had big inventory builds into
huge inventory builds.
So it just seems like there is concern that, you know, consumption, which is 70% of the economy, is starting to slow, despite, you know, what remains a decent wage environment. And then as far as kind of manufacturing, ISMs are you know, well south of 50. So that's recessionary territory. And if you think about China, it's kind of a global growth momentum, you know, wild card. Yes, they are likely to reopen, but they haven't seen anywhere near the level of stimulus to the people that we gave to our citizens here, or that Europe gave to theirs. So yes, they may reopen, but it's not commensurate with a massive amount of money printing. So, and I suspect it'll take longer, and there'll be bumps and starts, and I don't suspect we're going to get kind of just this kind of turn everything on and they go gangbusters, you know, imminently, right? The case counts are going to rise, people are going to get sick, the death count's going to rise. This is COVID all over again, and so we have to kind of get through that, I think, first. So maybe the bond market really is just getting very concerned about you know, all that growth momentum, and you know, maybe they're also concerned about, you know, then I guess maybe the other thing would be, is there something systemic that's under the hood that we're missing? The only thing I could think of there is that there's been some of these fund gates in housing products, right? The Blackstone REIT, and I think there's been a couple other ones. And so there's been maybe some liquidity issues in some of these kind of private equity, venture capital funds that have locked up money, and people want their money back, right? So, you know, and if you think about the leverage in some of those entities that have borrowed short and lent long, you know, maybe they're having their own, you know, liquidity issues that we need to keep an eye on. I mean, part of the 2008 crisis was, you know, the CMBS market, right? That no one was really talking about. It did kind of get tightened up. Maybe there's something going on there as we kind of move into 2023. Venture capital and private equity valuations, you know, which have held up well, all things considered this year, as those funds are taking big markdowns next year. Maybe that's an issue that the bond market's also sniffing out. But yeah,
all very good points. Solid. Let me ask you what you think about this, right? So this is speaking of, you know, the bond market pricing in recession, the 30-year less than 3-month yield, right? So we have just literally careened over waterfall cascade type of breakdown into inversion. And we can stay here for a while. I don't have the 1970s, but we stayed there for a while. But one of the things that I've been tracking, as you know, is this 3 month. I kind of use IRX, which is the 3 month interest rate index that came all the way up to a extended level, just has been parabolic. And now for the past, week or so is starting to go sideways. I have this kind of thesis, right? That now that the 3 month has hit my 4.18% area, we should start to soften over the next 1 to 3 quarters. Okay. Yeah. So, but I think the longer duration yields stay sticky, right? Mm-hmm. So I think that this is where we can see some inflation expectations declining, and it's seemingly right now bullish, but I still, as you have shown the real rate chart very, very well, it remains high. So so the nominal rates can remain very sticky. So I have, my price targets in the 10-year and the rest for, areas for support, because we're long bonds and TIP and yen and gold and, the whole thing. ZB, I can show that chart as well. But the point is, at some point, this is going to start to hit its head on resistance, right? That long kind of fishing basket worth. And then we need to cover, because I can see also this thesis of we're going to start to have kind of that bear steepening, like we have a hit on economic growth and stock and company valuation still come under pressure. I don't think tech is done going down. I think it has one more leg. I've made that case for the past month or so going into the first half of 2023. But what's your take on all of this?
Yeah, I mean, just look at this chart. I mean, look at when we get to a period of, so the more negative it goes, the more the curve is inverting, right? And then at some point that flips, and basically what winds up happening is the front end, the 3 month, so it's really more like it would be more like a bull steepener, in that the front end rallies, right? So the yields in the front come down. So look at 2001, and then again in the end of 07, 08 period, and then even really kind of in the 4Q 2019 period and all throughout COVID, right? Those periods of significant bull steepening are often associated with like recessions, right? I mean, so I think that's where, we're ultimately going to get to. And as the front end will come down when the Fed and markets are becoming more concerned about the growth outlook, and it's done enough damage to forward inflation that allows the Fed to kind of loosen up its policy. I think the reason that we haven't kind of seen that yet is because the Fed doesn't feel like they can really loosen up policy amidst this wage environment. But I don't know, maybe 3 months from now, if we're in a different place on growth and we're more concerned about wages, then we will have priced out all these any more tightening, and that IRX, which is basically the 3 month T-bill rate, that starts to fall, but 30-year at 3.5% really can't, yields can't really fall much more, because eventually the Fed is and will print and add liquidity back, which, and given a lot of the structural reasons why, I think duration longer term is a sale, China selling, Saudi selling, RMB for oil, various different things, that could lead to a, kind of the front end of the bond market kind of moving in a bullish way, and the back end kind of moving in a bearish way. Then you really could get a big steepener. But we're not there yet. But I think the first driver of that will be concerns about growth that are enough to get the Fed off of its tightening agenda.
Okay, so I'm showing right now T-bond futures, ZB1, retail product, TLT, very similar. But this is where the Bank of Japan came in, right? And not only did its massive yen intervention, which helped the yen rally, dollar pull back, it also put a bid in gold, and bonds stopped going down. But we also had China intervene and tell their state banks to start buying stocks to stem the selling. So on and on. We had a very, very nice bottom, let's say, in bonds. And then, of course, we had the CPI print last time, which was also bullish, not just stocks, but also bonds. And this is still, traveling very nicely, kind of this 45-degree angle higher. So Bonds are still bid. Obviously, we've been going through this every single day. Oil has been weak. I was asked in Q&A to kind of show the bond view, and I still see it as going up to 135. So clients have had this, but my point is, I don't think we're going to chop around here for sure. If we break 128, we've got to pull back. But for right now, with this, this particular product moving higher into 135, but then I think it's done, because big picture, this is still, you can't even see, but it's a 40-year massive, massive channel. And we have clearly broken down, rallied into resistance, crashed, and only got supported on October 21st when Bank of Japan intervention came in, period, end of point. It's the only reason why we stopped going down. So long story short, I'm still seeing this as the area where yields basically will start to get defended very, very strongly. Dollar get defended very, very strongly. And that's really all I wanted to say about that.
I mean, there's a part of me that says, if the bond market is as worried about whatever it's worried about as current pricing would suggest, then equities are very much the wrong price, right? I mean, if it's the case that curve inversion suggests a growth outlook that is way worse than consensus believes, then I don't see how we're going to have earnings growth next year kind of commensurate with whatever is being priced into a market that's at 40, 50. So now, maybe part of this bond market move is just lack of understanding about the Fed's reaction function, and we'll find out more about that tomorrow. But
yeah,
I think if this is, if we're moving into 2023 with, that yield curve inversion of 100, 150 basis points between terminal and where we're going to be 6 quarters out, that's the bond market pricing in an economic outlook that would historically not be a good one for stocks.
Okay. Along that same line of the ZB and your comment about, at some point they will, we've obviously had risk parity die with and deflation with COVID. So now that we've had this corresponding highly correlated move in stocks and bonds down, and now in this recent bounce, I was asked about TLT. So let me just first give a little preface here. I do this kind of intermarket analysis, which is compare and contrast ratio analysis, which helps me find divergences. It helps me find points of overbought, oversold, extremely overbought, extremely oversold. And long story short, you can see here is TNX, the 10-year, and here is a ratio of TIP to TLT, which basically, bottomed in COVID in March and has been moving higher. This has been a really great play also in kind of my wonky little intermarket of saying in August 2020, bonds are done going up. We had some sideways consolidation for sure in this 2021 period before it took off, and oil took off very strongly, actually December, that shouldn't say 2020, that should say 2021, from that 65 to 130. But the point is, now that we're pulling back, this is, triggering, in my opinion, just a pullback in inflation expectations. That's all that this chart means to me. And I pulled this up because it's related to TLT, because I was asked about it in Q&A. But it triggers in so many people this commodity deflation narrative, that we're going to be immediately going into a deflationary spiral. I wanted first of all, just to kind of share, I don't see deflationary spiral. I just see inflation expectations got, very, very rich, and now they're pulling back. In the same way that TLT bonds, since I'm working backwards to that question, got very, very oversold or cheap. And this is a convexity move of size right back into its mean. I mean, the mean is up here to this 112 area. I still don't see any reason why it can't reach it. But it doesn't mean that we're done having inflation and then we've moved right into a deflationary spiral. I just think this is a really strong oversold, convexity type bounce. And big picture, when this pulls back down, which right now was just the mean, we pull back into this channel, I would expect very much for this to get supported and move back higher. What's your take?
Yeah, I mean, I think the commodity story still has a lot of tailwind behind it, kind of from a structural basis on supply for one. I mean, we've seen just really a dearth of capex kind of into the commodity universe for the last several years, and so we're just not going to have the commodity supply growth, kind of unlike in 2016 and unlike in 2011 and unlike in 2008, where when we had those deflationary busts, they came with a massive amount of commodity supply that had been reacting to kind of prior cycles of high prices. Right now, we just don't have that this time. We just don't have the supply growth expected in the next 5 years. So I think commodities can stay snug on that. And then for the most part, kind of the climate revolution or whatever comes from that. Demand for metals that go into climate investments, whether they be copper, lithium, rare earths, aluminum, a variety of different things. We'll see a demand driver kind of similar to the demand driver that we saw in 2001 through 2011 with respect to China. So there is an underlying strong case to be made for real assets. And I would add, eventually, when there is more money printing, again, a dollar is weakened. That's another reason for hard assets. So I think there's a good underlying kind of multi-year commodity story developing. But in this kind of short-term period where, from a positioning point of view, most people tried to play this year kind of long commodities, long energy, long materials. And so we're seeing, some of that unwind. And I think you nailed the XLE column. I think maybe even almost to the exact day of the high, kind of calling a pullback there. But I think so we're getting some of that. And that probably continues for the next few weeks here. And if demand, and we go into a recession, it's going to be hard to see kind of demand acceleration for commodities. So I think short term, there's some of these deflationary forces on the good side, on the commodity side, that stay in there. But I agree with you. At the point in time when the Fed is forced to kind of react to the growth slowdown, and China also really reacts to its growth slowdown, that will be a good time to be long commodities again. I suspect we're going to get there at some point in 2023, but I don't think there's a rush right now as we turn the calendar.
And I'll be watching the 20-year. Honestly, this 20-year treasury yield, it could be the 5 as well. But the point is, we had this explosion higher, obviously in summer of 2020, formed a really nice inverse head and shoulder. This is a rate of change in this lower panel. Exploded higher, pulled back very nicely, right smack dab on support, and then exploded higher again. This recent pullback in yields on that Bankage Pan intervention on October 21st, I'm steadfast in stating again that was the reason for the season, that pullback in the dollar and yields, and obviously VIX suppression, but VIX is neutered anyway, so it's not been really strong on my list. Net buying, however, was extremely high on my list. As you know, we both tracked that, and it has been very strong. So a weaker dollar and definitely suppressed VIX, net buying and weaker yields. But now here we are, right? We've pulled back. Inflation expectations have also cooled. Oil has rolled over. Hence, the one-year inflation expectations are lower. CPI is lower. Wage inflation is still sticky. Unemployment is still low. But this is where I'm going to start to look for support. Remember, this is a massive 40-year channel, and it has hit every single level it's taken out. This was 2011 highs, and then we got rejected. So we come down here, we base a little bit, we create a pattern and a reversal. We'll start moving higher. And the next year, I keep getting asked, what's the trade? What's the trade? Well, I've just shown you, for me anyway, the dollar is moving lower. That's the reason for the season for stocks and bonds and yen and gold and the rest moving higher. Oil suppression, we'll talk about that a little bit separately. But as the yields pull back and get supported and then move higher, we're going to have a situation where the rate of change takes off very strongly again, and bonds can really careen over again with equities. So not today. Today, right now, we're obviously having this kind of skittishness with bond inversion foretelling recession, but the economy is still strong and stocks are still basically if you look at it big picture, just going sideways since May. And bonds are absolutely bid. So I highlight that because I think that this is still going to be tradable long bonds, and to be determined on Fed tomorrow. They could do a complete Fed pull, we know, rug pull, but in the meantime, that dollar has been very, very helpful to kind of directionally trade the markets, in my humble opinion. As far as oil is concerned, when we broke 93 on a monthly, that was just rollover Beethoven. We had lots and lots of channel surfing while SPR was basically getting drained. We're now at levels, I think they're even today, there was another news item that it was a 36-year low yesterday. I think it's lower now. But the point is, it keeps getting depleted. And the lows keep coming in. So my baseline bet has been if then. So it was high conviction from 65 to 130. Now it was either I don't know after 93 or it's if then. So every low keeps getting taken out. Every bounce keeps getting sold. So I still see a monthly pivot of 65 that I think is going to get defended very strongly. 102 in the dollar. And bonds obviously are quite robust. So I think we digest sideways and then we move higher into that 135 potential. We'll see what the Fed does tomorrow, but that's very bullish still. Gold and yen, and very weak, I have mentioned, with the dollar yen. Let me just show this real quick because I got that question as well. Okay. Dollar yen, this is the 151, firmly rejected. That was a price target that then rolled over definitively. This happens to be a yearly pivot and it rolled over some more. I think we can roll over some more. So that's where I think we're going to get supported in the dollar yen. We've also had a lot of weakness in the dollar yuan, and this is sporting more of a head and shoulders top. And there's still weakness in FX. So as long as the dollar stays subdued with VIX, and with yields, asked about that, I'm still waiting for this to come down into 3.33. So that hasn't happened yet. And I am still waiting. So in the meantime, it's very, very hard to call this equity, rally that has been incredibly dangerous for short duration bears and bulls alike, unless you are, just lucky or extremely well positioned and fast. Because I'm seeing fabulous fades and bounces intraday, but a lot of the action, as you know, is happening in futures right. Market. Very, very tough to kind of game what FOMC will do tomorrow. But we had a sizable bounce this morning off that 103.65, and as long as that holds, we could have some weakness in equities. But if that is taken out, we will see a continuation down to 102 and markets spiking higher into that potentially not just 4130, but also 4200. So that's just kind of like a quick overview, since I was asked in Q&A, what's your view for oil? I still see 65. What's my view for XLE? Let me just show that real quick. And we'll get back to a little bit more macro, but XLE was really a nice, rollover, gorgeous. We had a little bounce and they got faded immediately. I thought we'd have a little bounce here, but we took it out and then had a bounce. I still see lower levels, but the point is we have right now a little bounce in oil, a little bounce in XLE on all this excitement, but I don't think that trade is done or diamond short, but we will find out tomorrow how much of this forecast, for lack of a better word, is going to feed the market bulls, because they are totally, as you said, pricing in they're pricing in rate cuts, right? And normalization in 2024. And if Powell comes out with a forecast that's a little bit more hawkish, we do have volatility potential and a very large options expiration, the largest ever, this coming Friday. So we're set up for some more volatility.
Yeah. What I would just point to, like, from, an equity perspective, just, how some of these kind of off calendar reporters report, or if we get negative pre-announcements or positive pre-announcements, but I point out the airline sector today because we did hear from JetBlue and about, demand kind of coming in worse than expected for the month of December. And I think, and the sector got destroyed today. It's just another one of those areas where, if we start to see more earning disappointment, you had pointed out Costco, I think that was last week, and, Oracle today. And, I think as more of these earners come in worse than expected, because of a 4Q slowdown or because of concern about momentum as we head into, first quarter 2023, that could throw some cold water on, equity, euphoria, right? Because you guys are not going to want to hold stocks that, look, JetBlue is down 8% today, right? I mean, you're not going to want to hold things that you feel like may have some earnings risk and can show that kind of underperformance on a day like today when the markets are generally bid. So we don't really have a lot in the way of earnings. We have Lennar later this week. We have FedEx next week, which I think will be interesting. Obviously, it gets quiet, as we turn, to New Year. But keep an eye out for negative pre-announcements from companies. I know steel companies usually give some color either this week or next week. So, let's see how some of these Carnival reports next week. Nike also is next week. Micron's next week. So, yes, we're getting to the end of the year here, but these are some big, important companies that may help set the stage for how people are thinking about earnings for the first quarter. And if there is more concern about earnings momentum, there should be some opportunity there to if you want to be negative, to really find those names that are seeing deteriorating economic fundamentals.
And I know we have a whole bunch of questions that we have not gotten through by any stretch of the imagination. And by the way, thank you so much for attending and asking all these great questions. Oh my. I just want to, hopefully hold on, did I share it or not? Nope. Let's do that. Here's a chart, Craig, I want to ask you about. Okay, so this was a fabulous chart that I just put up yesterday. DataTrek had kind of this 2-year treasury yield year to date versus the S&P returns. You can see, obviously, as it rises, the S&P doesn't, right? It was a negative. We had that flat period, actually, June 15th, July, August period. And then we had a little bit more rollover August 16th into that October 13th low where the 2-year yields picked up and the S&P rolled over. I mean, this is not a bad look at the correlation between your 2-year yield and yours was even real. But the point is, we are in the flat period, and as long as this is going flat, market likes it. So any tells going into this particular indicator?
I've been thinking at some point, and I don't know if we're there now or in the next few weeks or it takes a little bit while longer, but at some point, I think that the market will need to come to grips with the reality that the pause from the Fed is not enough, meaning that holding rates flat for an elevated and restricted level for a period of time is actually, going to be getting more restrictive as inflation falls and as the economy slows. And so my sense is that the next move on the chart that you just sent me, that you just showed, which shows 2-year yields falling, that actually might come with stocks down. And the reason that it will come with stocks down is because 2 years rallying like that is indicative of a bond market that is increasingly concerned about the growth outlook, and of one where the Fed is unable to raise rates and, but likely still cannot cut rates because of the lag impacts of, still, strong-ish labor market. So, and if that is in the environment that plays out, then, even though 2-year yields will be coming down, if inflation doesn't fall as fast, if inflation falls faster, real 2-year yields will still expand, and that will be negative, for stocks. Because, in my framework, economic momentum needs or stock market and risk asset momentum needs Fed liquidity, and even the real economy, in order to reaccelerate, will need Fed liquidity, because we're just not going to get there on our own in light of, still weak. Look, GDP is driven by population, growth per capita, productive population growth per capita. Population is birth rate and immigration. Neither of those trends are particularly good. And productivity trends have continued to be, kind of mediocre. So in order to get acceleration in growth, we need to print more money. And that's what we've been doing for a long period of time. So, and when the Fed does that, typically supported for risk assets.
And then
now we don't have that, and we're not going to have that imminently, which I think is, part of the reason why I'm concerned about risk assets.
And very sticky wages.
Right.
With very low unemployment. So until that changes, debt ceiling on the 16th could be a trigger. A lot of government employees on furlough. We could also have, again, some black swan event. But for right now, in a normally operating market, we don't have, this type of drama known. So this is one of the great unknowns. Yeah. But I will comment, because I was asked in Q&A, where are we going markets next? From my intermarket, I can tell you only what I see is that we're starting to roll over. Now, this is a McClellan summation, but the point is we are definitely in SPY and NASDAQ. We are starting to get a very strong signal, just like we did for the rally, from August 16th over into the bottom of October, higher. This has not triggered yet in RSI, but it has rolled over. And my other, do
you have that indicator back to the end of last year?
I can go find it. Yeah. But
the only reason I ask is because most people kind of look at, the Santa Claus rally as made it difficult. But I thought I remember last year too, in December, we had a nice move lower. And then the last week of the year was up, and then we were straight down to start the year. I wonder if not that last year is the only indicator, but it's just interesting that your indicator is rolling over in what is normally seen as a seasonally strong point of the year.
I think it's tired. It's just bloody momentum is waning, and it's just tired. This is just one of many, right? I mean, I got all kinds of stuff that I use, but in regards to what most important to me is dollar yields, net buying or selling, and so far those are still supportive for higher, but my intermarket is absolutely giving me the opposite, and this is just two of many. But my point is, and whether it be NDX or SPX or NYSE, they are definitely rolling over. We have not had the confirmation in price action yet. So it is fascinating to me that we have this volatility intraday, but that doesn't stick, because this is the most volatile market since 1950 intraday, which is saying something. Yeah. So, and I know we've said a lot in the last hour, and we're not going to get through a lot of the questions because there's tons, right? We go like that we can't even anticipate. We'll have to do this after FOMC, which, by the way, I run a live trading room during the FOMC 2 to 3. Craig will chime in with his interpretations of what Powell is speaking. And of course, we'll be able to see live the market reaction, gold and dollar and yields, oh my, stocks and bonds. And that will definitely set the tone for the rest of the year and into Q1. But I have, again, kind of put my warnings out there that I still see one more leg lower in tech. Most are not seeing that. I don't mean some of the oversold plays that are potential buyout candidates in mid-tier tech. Maybe we get a policy passed in the pot stock. So there we get a lot of oversold stuff that can pop up. But as a sector, I do not see NASDAQ outperformance, especially the FANGMAN stocks. So I've done a video about that back in early November, and we'll revisit that at the beginning of the year to kind of talk about particular sectors. But you and I know you were early on the bullish gold trade. I was only bullish as a swing, and it has extremely outperformed even my expectations. So that's going to be a leading sector that I know we're going to highlight in the beginning of Q1. There's no question in my mind that's going to be a really strong one. But then so is oil. I think this has got to get down to that 65 I've been talking about since summer. and it's weaseling its way down, then I think we get supported. But I think it's going to time very much with a bottom in dollar and yields as well.
Yeah, I see someone. No, I see someone in there on asked a question about Ukraine, and I don't really have too much of a view about that. But what I would say is we're in the window here from Putin. I think from Putin's perspective, between now and March, where he has more leverage than not. Right? If the winter, if he's going to do something, now would be a better time than waiting for the spring or summer when he has less pull to kind of, screw over Europe with the gas flows. So that is kind of an exogenous risk that, is in the back of my mind. I don't really know exactly, whether or not it impacts my day to day, but it is something we should be, kind of mindful of if over the weekend something were to happen, over any weekend, right? Mm-hmm. Something were to happen that could change things. And then I think just as far as oil is concerned, still trying to figure out just the SPR buying. Is the administration really going to be buying oil at 70? I'm actually suspicious. I actually don't think they're going to be. I think they're going to wait. I think they are going to, try to keep the oil market, snug so that the U.S. domestic producers feel like the administration is on their side. But I don't know, from a narrative point of view, I find it hard to believe that Democrats and Biden is going to be able to spin a message to his constituents about that it's a good idea for the U.S. to buy oil and raise gasoline prices and destroy the environment, right? I mean, so I'm a little bit skeptical that they are going to be there with a big check at 70. We actually don't need as much oil as we used to in the SPR. The SPR is in the wrong place, right? It's in Texas and in the South where we create a lot of oil, and we have shortages of products in the Northeast and in other places. It's not a great, we could be doing other things if we wanted to secure our energy future. So I wonder if we're actually going to get as much.
And my whole thesis on oil from the very beginning of summer 2020, it's been things over paper, and then it turned into oil is the inflation hedge, and then it turned into oil. It's basically a rates trade, period. Yep. So its correlation with yields is ridiculously tight. So I don't even have to look at supply and demand. I know that's what you and Bob, fundamentally and macro and the rest. For me, it is a pure rates trade. Yes. So, all right, we're going to have to end here. Thank you so much for staying late. Reach out to Craig on Twitter or in DM if you're a client via Slack. Where I can be found. And also, again, tomorrow, FOMC, I will have the live trading room. If you're not a client, feel free to pop in. We've got a week pass. You can see everything posted in Slack that you're seeing from Craig and myself. Make sure you sign up for the Macro Advisor Bundle. That's where Craig will post his analysis tomorrow, also live via the FOMC and Powell. So go to the pricing page and you'll find it. I wish I was more organized here on my little pitch here, but I that's not my thing. All right, so basically we're done. We're going to wish you a great rest of the year. This is our last webinar for the year, unless something totally momentous happens, like debt ceiling doesn't get resolved or something. But otherwise, we're going to see this week through. Be very safe, right? Tomorrow, FOMC, and Friday, the largest notional value in quad witching, which will have a ricochet effect at some point, if not this week, next, most likely. And then we'll just try to get through this year so we can start fresh in January. Craig, I wish you a great rest of the week, and everyone, thanks again for joining.
Sounds good. Thanks, Sam.
Cheers. Bye.